discussing about a 4-step winning option strategy. Yes, you heard it right. So before I get started, I want you all to press the subscribe button and subscribe to my channel so that you can learn more about trading and investments. So before I get into the strategy, let me tell you an overview as what is the logic behind this strategy. So whenever you are coming out with the strategy, there are multiple types of strategies. You have weekly expiry strategy, you have monthly expiry strategy, you have intraday strategy, etc. And the more commonly occurring strategy will not give you the highest return. Okay, the highest return is given by strategies which occur once in a blue moon, right? So there are strategies where the setup occurs very rarely, but whenever they occur, and if you are able to capture that, you will be able to get wonderful results. So the strategy what I am going to talk today is the strategy which should be applied on stock options. Okay, so there are various conditions. So I have filtered them down to 4-step winning strategy. So there are 4 steps which you have to follow, and if all the 4 steps occur, then you can go ahead and implement the trade. The trade is reliable and the profit is also pretty much decent. Okay, so before I get into the strategy, now let me tell you how a stock behaves, especially the stocks which are in futures and options. So a stock, whenever they go higher, they can't keep going higher. So probably 100 rupee stock can become 200, 300, 400, 500, 1000, 2000, 3000. But after some time, they have to reach a point and where they have to retrace. This is a common behavior of the stocks, especially in the futures and options. But the other side is not true. If a stock is falling, it can fall to any extent. Okay, we have seen where 1000 rupee stock fall and come down to single digit or double digit. Okay, so don't think a stock has fallen more and there is no more chance of it falling even more. Okay, if a stock has fallen 50%, then there is equal chance of that falling another 50%. Okay, whereas if a stock is going higher, the stock cannot go higher. So in this strategy, we will try and capture the retracement. So for capturing the retracement, you should know what is the highest point. Okay, because just because a stock has gone from 100 to 200 doesn't mean that is going to be the highest point. It can even go to 500, it can go to 1000. So there are some indicators and data which we have to keep an eye on, which will give us an idea that the stock upper limit has reached and now there is a good probability that the retracement might happen. Okay, again, it is a probability, there is no guarantee, but from my experience after implementing this strategy for a long time, I can tell you this 4th step what I am going to explain now is pretty much reliable. Okay, so now let us see what those 4 steps. So now I'll take an example. Now let's say Adani Enterprises. Okay, it has gone up. So from 2000 rupees, it went to 2200, 2500, 2800, 3000, 3200. So now how will you identify what is the limit? Because this is the first time it is going to that level. So there are some stocks which might have fallen drastically, and again once they start going up, you can consider the previous high as the highest point. You can expect the stocks to retrace once they reach the previous high. But in these kind of stocks where it is making a fresh all-time high, so it is difficult to predict as to what is the new high which is going to be formed and when it is going to retrace. Okay, so the first indicator or the first step what you have to check is what is the RSI. RSI stands for Relative Strength Index. So you have to check whether the RSI is above 75 or 80. The more the RSI, the more conviction you will get that a retracement is possible. Okay. So identify those stocks whose RSI is more than 75, 80, 85, 90. Okay. Keep an eye on them. Okay. So this is the first step. The next step is you should see what is the distance, how far is the stock away from its 20-day moving average. Okay. So the analogy of this is, if a stock moves too far from the 20-day moving average, then there is a good chance that it will retrace back to its 20-day moving average. Okay. This is the analogy. So what is the ideal distance for a stock to be away from the 20-day moving? So from my experience, what I have seen is, if a stock is 20% away from its 20-day moving average, then after that you can expect the stock to retrace and come back to its 20-day moving average. If not come to 20-day moving average, there is a chance of the stock to retrace and fall slightly. So this is the next condition. So now, where do you find these data? Okay. So RSI, there are various sites where you can go and check stocks which are greater than, check stocks whose RSI is greater than 75, 80, 85, etc. But where do you find which stock is 20% away from its 20-day moving average? So let me just show you that in my screen. So I hope you guys can see the screen. So this is the link which I use for finding out the 20-day moving average of all stocks which are in futures and options. So this is a list. So again, I am not promoting this website. This is a website which I found by Googling it. Okay. So I will be giving this link in the description below so that even you can use the same data. So here you can see they have given all stocks. Its close, its simple moving average 5, 10, 15, 20, 50, 100, 200. So now what do? I just copy this data. Okay, so let me just, so you copy this entire data, you open Excel, and in Excel you paste this data. The problem here is there are some few blank lines which you may have to remove it. Okay, so delete. So let me just remove some of the blank lines. Yeah, here. The reason is I will be doing some sorting and other things where this blank line will disturb me. Okay, so let me just remove all the blank lines which are there. Right. So it looks like all blank lines have been removed. So here I will insert another column called diff. Okay, so let me just put borders for all of them so that you will know what is happening. Okay. So what is diff? The diff column tells me what is the percentage of the stock price from its 20-day moving. So how do you find out that? It's very simple. You find the difference between this and 20 DMA divided by the close into 100. Okay. Now you apply this for the entire sheet. I hope it is applied everywhere. Let me just check that. This is the problem. That's why I told we have to remove the blank lines. Okay, I hope now everything is done. Yes, everything is done. Okay, let me go to the top. So now you find all this. Now I am going to sort this column. Data, sort, expand the selection, sort by diff. Okay. So here you can see that PVR limited has been falling, which we are not interested. So the difference between PVR close and its SMA 20 is almost 10%. But this is the stock which is falling. We are interested in the stocks which are here. So here you can see that RBL Bank is 18%, ABB is 10%, IDFC First Bank is 8%, 8%, 8%, etc. Okay. But here the closest one is RBL Bank. Okay. So today you can see, if you see RBL Bank chart, in last 3 or 4 days, RBL Bank has shot up approximately 25 to 30%. So obviously when a stock shoots up 25-30%, it will definitely be at a very good distance from its 20-day moving average. So you can consider stocks which are greater than, which is at least close to 20. Okay, 18, 20, close to that. Okay. So here in this example, I am not going to consider RBL Bank, which I will be telling you in some time. Okay. So you can keep an eye on ABB. ABB is already at a distance of 10%. In any case, if this becomes 18% or 20%, you can think of implementing this strategy on ABB. Okay. As I told you in the beginning, this is not a strategy which comes every day, but when it appears, when all the conditions meet, you can blindly implement this strategy where the win ratio is very high. Okay. Frankly speaking, from the time I have been implementing this strategy, I have not even come across a single trade where I have lost money. Okay. So that is how accurate this strategy is. Okay. So that is the second condition, where the first condition is RSI should be greater than 75 or 80. The second condition is the stock should be more than 20% from its 20-day moving average at least. Okay. Now the third condition is, since we are dealing with stock options, there is a very high chance that when a stock moves so rapidly, it may enter into a FNO ban. Okay. So as per exchange and SEBI, in order to reduce the volatility, so what they do when a stock's movement is very high, when it is very volatile, they move those stocks to FNO ban list, which means if you have positions in those stocks in FNO, you can only exit them. You can't initiate fresh trades, which means the open interest cannot increase. Okay. And it's not that you cannot initiate fresh trades. If the stock is in a FNO ban period and if you execute new trades in FNO, then there will be a penalty which will be applied on. Okay. So because of all the penalty and all the complication, usually nobody initiates fresh trades. Okay, if they are aware. And I did this mistake some time back. So I got a perfect setup in Vodafone Idea some time back, and I did not check the FNO ban list. I directly went ahead and executed the trade, and after that I came to know that it was in FNO ban and I had to pay some penalty. Okay. So I don't want you guys to do the same mistake what I did. So how do you check whether the stock is in FNO ban or not? Simple. You can go to the NSE website itself. So in Google, just type NSE FNO ban. Okay. So it will take you to a NSE website. Yeah. So here you can download this file where it will tell you what are the stocks which are in FNO ban for that day. Okay. So whenever you are implementing this trade, make sure you check this well in advance. Okay. But after you take the trade, the stock can go to a FNO ban, right? So now, for example, we take the trade and the stock goes to FNO ban. In that case, it is sometimes good, most of the times it is good, and sometimes it is bad. What happens when an FNO goes to a ban state in this criteria? So it means the stock has shot up too much, because of which it has gone to a ban state, where the open interest has increased and the price has also increased, because of which now the SEBI and exchanges have put the stock in FNO ban list. So now there can't be fresh FN open interest that can be created. So in that case, only short the long covering only will happen. So whoever have executed or bought the futures and option for that stock, so now they will start covering their positions. So once they cover, there is a high chance of that stock price coming down, which is exactly what we want. Okay, the trade what we are going to take is a short trade. Okay, or it is a mild bullish trade, which I am going to discuss in some time. Okay, so these are the conditions which you have to keep an eye. So now, what is the trade? Okay, so here we are assuming that the stock price will not go higher further, so there will be some retracement. So you can either go and sell naked deep OTM call, or you can execute a call ratio spread. Okay, so now let me just give you an example of the trade which I did recently. So recently in my previous video, I spoke about how I was able to make 10% in 3 days by trading in Adani Enterprises. So now let me just open Adani Enterprises for you. One second, guys. Adani Enterprises. Okay, so here you can see, okay, there is no, I'll just add RSI indicator, RSI relative strength index, the default one, whatever comes. Okay, so here you can see Adani Enterprises, and let me just add a 20-day moving average as well. Moving average. Okay, it's taken 9, so I'll make it 20. Okay, so here you can see that Adani Enterprises from 2000 has gone up to almost 3300 approximately. Okay, so when it was here, you can see that the RSI was more than 90. Okay, and at this point of time, the difference between the Adani Enterprise spot price and 20-day moving average was more than 16-17%. I don't remember exactly. And you can see that Adani Enterprises was not there in the ban period as well. It was not in FNO ban. Okay. So since it was not in FNO ban and all the conditions were met, I went ahead and sold 3600 call option, which was the last strike price. Okay. So if let me just open that in the option chain. Option chain. So here I'm going to search for Adani Enterprises. So here you can it's still in Nifty. Okay, cool. So here you can see that the last strike which was there was 3600. So I went ahead and sold one lot of 3600. I sold it at approximately 93 rupees because this was the last strike which was available. So I went ahead and sold it, because if there was any other strike beyond that, probably I would have sold them. But since this was the last strike, I went and sold. And after that, you can see there was a retracement which happened slightly. And when this fell, my Adani Enterprises option, what I had sold, even that fell and came to almost 35. Okay, and which already gave me more than 10-12% of my capital. So I was happy with the profit what I had made. So I closed the trade and booked my profit. Okay. So if you are not really confident of going short by selling naked options, you can go and execute some call ratio spread. So what you can do is you can buy probably 3,400 or 500 call, and you can probably sell 2 or 3 lots of 3,600, where your break even point will be slightly more than the naked option selling. Okay, so this is another strategy which you can implement. So I talked about 3 conditions, right? One was RSI above 75-80. Second one is difference between 20 DMA and the spot should be more than 20%. And the third one is it should not be in the F&O balance. I told there are 4 strategies, 4 steps. So what is that 4th step? Okay, which I will be explaining it to you now. Whenever a stock option opens, when the new options open, which is 3 months before, exchange open strikes for a limited number of So for example, let's say Reliance is at 2,500. Okay, so when the new month options are open, the strikes will be open from probably 1,000 to 4,000. Okay, I'm just giving you an example. Okay, so if you want to sell 10,000 call option, that is not possible because that is not opened by the exchange itself. So when exchange is deciding the range, which is 1,000 to 4,000, so they have their own calculation where they find out that the volatility may not exceed from 1,000 to 4,000. That's why they have opened only those strikes. But sometimes what will happen, the stocks will rally such that it will the last strike will become in the money. So which means in the Reliance example, if Reliance shoots up from 2,000 to 4,000, okay, which is almost double, okay, at that time there won't be any strikes beyond 4,000. So in that case, what will happen? Exchanges will open a new set of strikes on the next day. Okay, so they have their own calculation as to when they have to open the new set of options. So now, when the new set of options are open, the new set of strikes will have a lot of trading which will be happening. So on the first day, when the new set of options or strikes are opened, you can go ahead and sell some of the deep OTM options or call options, okay, which will give you a decent return. That return depends on the risk you are willing to take. So I usually sell options which will give me approximately 5 to 10% of my capital. Okay, once in the new set of strikes which are okay, and I can tell you from my experience, when exchanges open a new set of strikes, I have not seen even a single time where even the new set of series are also over. It means the last out of the money strike which is there, that has never become in the money in my experience. So you can confidently go and sell the deep OTM call options, but make sure you get a return of approximately 5 to 10%, which is a decent return. Okay, I hope you guys like the video. So before I close, let me just summarize the 4 conditions what you should keep an eye on. The first one, the stock should not be in the ban list. Second one, RSI should be more than 75 at least. If it is more than 80, 90, well and good. Third one, the difference between the stock spot price and its 20-day moving average should be more than 20% at least. Okay, if not 20, at least 18 to 20, in and around 20. And the last one, in case if there are new set of strikes which are open, then you can confidently go and sell some deep OTM call options where the return is around 5 to 10%. Okay, whenever a new set of series strikes are open, I confidently go and sell more volume of call options, which will give me more than 5 to which will give me profit of around 5 to 10%. I hope you guys like the video. Do like and subscribe to my channel so that you can learn more about trading and investing. Thank you guys.